US economy is a lot weaker than the headlines would suggest, the headlines the media and the politicians would suggest. You can see that in a lot of things, but particularly the employment picture. We had that massive jobs revision, new jobs revision number last week by the Bureau of Labor Statistics, where they said they had overestimated new jobs by 818,000. I mean, that's massive. So that kind of puts a dent into the strong labor narrative. And the other thing, frankly, is that you look at this year, pretty much all of the net jobs growth has been either part-time jobs or government jobs. And that's not a healthy economy. So we could go through all different sectors of the economy, but basically I think the economy is already weaker than it appears, and the employment in particular, and that's, I think, the employment picture deteriorating. Well, why it appears the Fed will act next month. So that's going to have an impact, obviously. If the Fed starts cutting rates, that's going to have an impact on the economy, but also on all markets. Typically, we would expect that when the Fed starts cutting rates, then there will be a period, whatever that period is, a year, 2 years, of rate declines, whether it's every meeting or every second meeting or whatever, but the trend will be to cut. They don't cut, then raise, and cut, then raise. You've got to start really cutting rates meaningfully for it to have an impact on companies and households whose interest rate charges have gone up so much. So typically, when the Fed starts cutting rates like that, it's a sign that we are in or heading towards a recession. And the interesting thing is that that is actually a very, very positive environment for gold and gold stocks. Not the recession itself, but the Fed's reaction to recession is very, very positive for gold and gold stocks. Interestingly, it's a lot less positive for stock markets, and it makes sense. Because when the Fed starts cutting rates, it's a sign that the economy is slowing. If the economy is slowing, then even if companies are helped on the interest rate, on the debt side of the equation, they're finding demand for their goods and services goes down. And so we're going to start to see earnings, decline, and that typically is bad for stocks. So I think the period we're heading into will be positive for gold and gold stocks, negative or neutral at best for the equity market. And when I say neutral, I mean it'll be very negative for some stocks, like the long duration unicorn stocks. They will tend to be hurt, and we'll get rotation into more value-oriented stocks, more real stocks, stocks with good dividends, and hopefully into commodity stocks. You can look back from 1966 when the market peaked. It didn't exceed that peak till 1982. This is not pre-war history or anything, because we could talk about the 1929 crash. But anytime you mention the 1929 crash, people roll their eyes and say, well, that was then, this is now. But 1966, that's when the Beatles came out. So it's relatively recent. 1966 to 1982, before the stock market exceeded that peak. That's a long period of flatness. And of course, that period, just like 1929, was preceded by a long period of, dramatic growth in stocks and dramatic overvaluation. When your starting point is a point of overvaluation, right, like 1966, and I believe like 2024, when your starting point is then, your next several years are going to be much, much lower returns for that market to get back to a sort of long-term median of growth. Again, it's cyclical. We've seen periods, in the past 50 years when foreign markets have outperformed the US market. In the 50 years that I've been watching foreign markets, this last 10 years is actually the longest period I can think of when the US has been the leader, and so dramatically the leader, for so long. Yes, every quarter, every year, there's one market somewhere that's outperformed the US. But basically, the US has been the strongest stock market in the world among all the major markets for a decade now. And that is an unusual period. Going back, there's been periods when Japan has been the leader, when Europe has been the leader, and the US market may have been a meaningful underperformer. So I think it's all cyclical. And, we're just going to go back to that period of foreign markets outperforming the US. I don't look at it as timing, because timing sort of implies you have a crystal ball and you're making, you've got the inside track on what's going to happen ahead. But I look on it more as looking at what's good value and what's overvalued, what's undervalued. And, if you like, that becomes timing, but not from sort of predicting anything, just looking at valuations. So right now, for example, in my managed accounts, the accounts we've got in the last year or two that want just gold accounts, they're fully invested. And the reason they're fully invested is because I'm finding lots of good value in that sector. The conservative global accounts that come to me are still 50% cash. And it's not because I've made a prediction, I think the stock market's going to fall. It's because I'm not finding sufficient number of good quality companies that are undervalued. So if that's your prism, then it sort of takes care of itself. You either hold a lot of cash, or you're fully invested, or you're invested in this sector, or you're invested in that sector because of valuations. I certainly have concerns about financial institutions, including banks. A lot of the regional banks, the smaller banks, a lot of insurance companies, pension funds, for example. The banks will be helped by lower interest rates, right? More banking problems is not number one threat that I see if we move into a period of rates coming down. I think the risk to banks and also insurance companies and also pension funds, frankly, will come from commercial real estate, because we all know the commercial real estate market is not doing well. We've all heard the anecdotes about buildings that's, sold for $4 billion 5 years ago and then were sold last week for $500 million. We've all heard stories about new office blocks that have 20% occupancy, etc. But there's an extend and pretend on valuations. So a bank does not want to foreclose. They certainly don't want to foreclose on a lot of properties. So long as they can keep those things on their books at the value marks that they have, they're happy to do that. There is a point, of course, when you can no longer pretend, if the lender goes bankrupt, for example, you have to change your marks. If you're in a syndicate and everyone else in the syndicate is marking down, you have to mark down. If you have auditors come around and start saying, I'm not sure about these valuations, you have to change the valuations. And I think that's where we're going to see a big structural risk in the US economy. You look at, for example, banks and insurance companies. I mentioned syndicates. A lot of these big office buildings are syndicates, and sometimes they're international syndicates. You've had Japanese banks and Japanese insurance companies write off, not down, but write off their loans on certain buildings where the US banks are still valuing those same loans as part of the same syndicate at cost. So someone is wrong. Maybe the Japanese are being too conservative, but also the US banks and the US insurance companies, because the same with the insurance companies, I think are being too optimistic, would be the nice way of putting it. So I think that's definitely a risk. The other risk, of course, with the economy, and everybody knows this, but I think it's worth emphasizing, if the economy starts moving into a recession, let's not forget that the lower 50% of the population in terms of net worth and in terms of income are already really struggling. When the dollar store has sales plunging, that's a really bad sign. Now, you look at Walmart, for example. I think it's important we differentiate. You look at Walmart, and Walmart is doing well, but the CEO on several of the quarterly calls in the last year has said they're noticing an influx of higher income consumers coming into their stores. So, the person that normally shops at Neiman Marcus or Nordstrom might go to Walmart to buy, or Target to buy stuff for their kids. They're not going to go to the dollar store. And so things like Walmart are doing well because of higher income people coming into their stores. Things like McDonald's and the dollar store, which are really focused on lower income consumers, are doing poorly. And we mustn't forget 50% of a population already thinks we're in a recession. And when the economy in aggregate moves into a recession, then half of the population is going to be suffering quite severely.